Hello, I'm Dr. Q. This session discusses details about evaluating the overall performance of an economy. National income accounting does for the economy what private accounting would do for an individual household or business. The Bureau of Economic Analysis, an agency of the Department of Commerce, compiles the data and reports it in national income and product accounts. Economists and policymakers use this information to make decisions in the nation's best interest. The primary measure of the economy's overall performance is its aggregate output. This is most calculated as gross domestic product, or GDP. GDP is a monetary measure in that everything is valued in dollars. All goods and services produced must be converted into dollar values for GDP to work. To avoid multiple counting of goods, GDP includes only the market value of final goods and ignores intermediate goods, which are goods either purchased for resale or for further processing into final goods. Alternatively, GDP could avoid multi-counting by counting only the value added at each stage. Value added is the market value of a firm's output less the value of the inputs that the firm purchased from others. GDP is a monetary measure because we would not otherwise be able to determine if total output has changed from year to year, if the mix of goods and services changes. For example, if an economy in year one produced 3 sofas and 2 computers, we can now just add 3 to 2 and got 5. 5 doesn't tell us anything about it's a sofa or a computer. So what we do instead is we use 3 sofas, multiply the market price of each sofa 500, plus 2 computers, multiply the market price of 2,000. The monetary value together is $5,500. Next year, the economy decreased the production of sofas from 3 to 2, and the computer's production increased. We can, of course, not add 2 to 3 and get 5, which doesn't tell us anything. Again, we use 2 sofas multiplied monetary value of sofas, plus 3 computers multiplied the price of computer, and got our GDP. Now we can compare the GDP in year 1 against year 2 in its monetary value. This table illustrates the value added in a 5-stage production process. The value added is calculated as the difference between the sales value of the materials and the value of the good at the previous production stage value. Using this method will avoid multi-counting. For example, this one tries to calculate the GDP contributed by clothes. It investigates the different stages in the process of production. Firm A has a sheep ranch. It creates from 0 to 120 as a wool producer. Then from A, sell the raw wool to wool producer in 120, and the wool producer add on a production process and bring the value up to 180. So from 120 to 180, the value increased by 60. And from B, sell the wool to the coat manufacturer. And the coat manufacturer bring the value of the stuff from 180 to 220. The value added is 40. And the coat manufacturer further sells it to clothing wholesaler at 220, and the clothing wholesaler add value and bring the value up to 270. The value the firm D brought in is 50. And finally, they distribute the clothes to retail clothier. They sell the products to final consumers at 350. If you simply add those values up, which is 0, 120, 180, 220, you got this 1140. It is not GDP. It is total sales value. What you should do is only adding up the value of the products added at each stage, which is 350. This is the same if you use the final product approach, 350, 350. Here's a practice. Please pause and do it. The answer is coming. All right, the answer to this question is say. Let's try another one. Please pause and do it. All right, the answer is $1,200. You can do it in two ways. The first way is to check the value of the final product, which is $1,200. You will get the same answer if you use the value adding method. This is the value of the product at each stage. And you figure out the value added at each stage. And you add up, also give you $1,200. Here's a report of organization and annual survey of manufacturers used by census to calculate GDP. It asks about the value of the final product, and the value of all the input. Non-production transactions must be excluded from the calculation of current GDP since they have nothing to do with the production of final goods. There are two types: purely financial transactions and second-hand sales. Pure financial transactions include such items as public transfer payments like Social Security, private transfer payments like Christmas gifts, and stock market transactions. Please note that the government pays Social Security or welfare or veterans payments to households that contribute nothing to current production. Besides, other than the service provided by the stock brokers, the stock market transactions produce nothing. Therefore, they are not included in the GDP calculation. Second-hand sales contribute nothing to current production and are ignored when calculating GDP. In sum, when calculating GDP, only focus on the new creation or production. GDP can be viewed from two different perspectives. The income approach looks at GDP in terms of the income derived or created from producing goods and services. The expenditures approach measures GDP as the sum of all the money spent buying the output. In theory, either method should yield equal results. The expenditure and income approaches are two different ways to look at the same thing. You could look at a quarter from the head or tail sides, but it's still worth the same amount. This is the same as the expenditures and income approach for calculating GDP. Here are the graphical expressions. The bottom arrows illustrate the income approach. Households and other social identities provide firms and businesses with factors of production, such as labor, capital, and entrepreneurial ability, to produce goods and services and receive wages, rent, and dividends in return. The top arrows illustrate the expenditure approach. Consumers are composed of households and social identities who purchase goods and services provided by firms and businesses. More illustrations of the two different approaches to measuring GDP are provided on this slide. On the left, the expenditures approach measures GDP as a sum of four items. 1. Consumption by households. 2. Investment by businesses. 3. Government purchases. And 4. Expenditures by foreigners. On the right, the income approach uses different inputs. 1. Wages. 2. Rents. 3. Interest. 4. Profits. And 5. Statistical adjustments. Each of these items will be further discussed next. Let's focus on the expenditures approach first. The first component is personal consumption expenditures, indicated by a say notation, which covers all household expenditures on final goods and services during a year. In any given year, approximately 10% of those expenditures are for durable consumer goods, which are defined as having a life of 3 years or more. Another 30% go to non-durable goods, such as food, clothing, and gasoline. The other 60% are for services, which has led to the United States economy frequently being referred to as a service economy. It includes expenditure on domestic and foreign goods as long as the U.S. residents purchase them. Personal consumption expenditures account for 70% of GDP. The second component of the expenditures approach is gross private investment, which is noted as I subscription G. In 2019, it accounted for 19% of GDP. Private means private businesses, not government investment, and it must be domestic investment as opposed to overseas investment. Gross private investment includes all final purchases of machinery, equipment, and tools by businesses, all construction, and changes in inventories. These items represent ways businesses invest in themselves. Construction includes new factories, warehouses, and stores, as well as residential construction because homes could be rented to produce income. Changes in inventories can be positive or negative. It represents the difference between production and sales during a period. This category includes additions and withdrawals of physical inventories owned by private businesses. Please note that the research and development, creation of new works of art, music, writing, or films, and the innovations that increases productivity are all classified as gross private domestic investment. In sum, Gross private domestic investment focuses on the creation of new capital assets. Non-investment transactions, such as stock, bonds, and resale of assets, are not included. Let's do some practice. Please pause and try. And the answer is GDP in 2010 is 500 billion. The unsold ones go to inventory, which is also part of the GDP of the current year. Depreciation of capital occurs when firms use fixed capital for production. Depreciation is the reduction in the value of a fixed asset due to usage, wear, and tear. The passage of time, or obsolescence. An assembly line's value differs from that of 10 years ago. The difference between gross investment and depreciation is net investment. This net investment expands the stock of private capital from the beginning to the end of the year. Allowing the economy's production capacity to expand, assuming all other things equal. The last two components of the expenditures approach are government purchases and net exports. Government purchases are officially labeled government consumption expenditures and gross investment. It includes expenditures for goods and services the government uses in providing public services and expenditures for publicly owned capital, such as for schools and roads. It excludes government transfer payments such as Social Security, because they simply transfer government receipts to certain households and do not generate any sort of production. It includes government expenditures on research and development and economic know-how. Net exports are calculated by subtracting the value of imported goods from the value of exported goods. Adding up all four components provides a measure of GDP, a measure of the market value of a specific year's total output. This table calculates GDP for 2015 in the United States by both the expenditure approach and the income approach. Note that both methods come to the same total of GDP for the year. Please spend a few minutes to review. Let's do some practice. Pause and come back. Alright, according to the formula for the expenditure approach for calculating GDP, it is a summation of consumption 90, gross private domestic investment 20, government purchase 15, and net export. Net export is the difference between export and import. Therefore, the GDP is calculated as follows, and it is 121. This table compares GDP for selected nations for 2014. The United States, China, and Japan have the world's highest GDP. Note that all data have been converted to US dollars via international exchange rates. Alright, in the next one, we'll talk about GDP calculation with the income approach.